Hi there. Welcome to this Karma Academy session on M&A, and I'm Tommi Uhari. I'm one of the partners here at Karma, and one of the things that mostly excites me, like in our portfolio companies, is the time of exit. So it's a topic that is kind of close to heart. In this academy track, what we typically like to do is to share experiences and bring in like world-class experts, and so that they can share their know-how to audience in events like TechChill, where we are today. And I've got with me here like Sven Raeymaekers from GP Bullhound, and Priit of Splunk, who was heading Plumber, one of the Karma portfolio companies, and Splunk acquired it. But maybe we could do like a brief introduction from Priit and Sven here, and then to kick off with a few questions. But maybe Priit, if you go first. So great to have you here, but maybe a brief intro on yourself.
Thank you, and thank you for having me, and great to be here. Indeed, I was one of the founders and the CEO of Plumber. Plumber is an application monitoring company. We produced and sold software that monitored digital services and showed to the owners of these services how well these services work. And we sold Plumber last year to Splunk, which is a public US Nasdaq listed company.
All right, thank you for sharing. I think we can have like specific questions on the process later. Sven, maybe a brief intro on yourself and GP Bullhound.
Yeah, no, absolutely. Thanks, Tommi. Great to be here today. So my name is Sven Raeymaekers. I always say, despite the first name, not Swedish. Actually, originally from Belgium, but I moved to the Nordics about 18 years ago. I have a mixed background. I started out in technology startups. I then joined slightly larger startups, including Nokia and Microsoft. And then in 2015. I joined GP Bullhound as a partner in the Stockholm office, but still based out of Helsinki. For those of you who are not familiar with GP Bullhound, so we're a global technology investment bank. So we focus on technology. A couple of key sectors, software being one of them, marketplaces, fintech, and so on. Aside from our advisory business, which is helping entrepreneurs and shareholders either raising capital or exiting the business, we also have an asset management business where we actually invest, a separate team that invests in technology startups. Been around for many years, more than 20 years, headquartered in London, but offices across Europe, US, and Asia.
Thanks for that. Maybe like first a question on the M&A market. That what does it look like in this time of like super high valuations on stock markets and zero and negative interest rates, SPACs and so on. So what does it look like? Are startups being bought left and right, or is it more difficult to sell them in these times?
Yeah, I mean, good question. Let's maybe start from the top, in the sense that in March 2020, I think it's fair to say, and maybe different actors in the ecosystem felt it directly, but global M&A was heavily affected. Management team, shareholders were literally shifting their attention to keep their teams and businesses safe. I would say that by summer of last year we saw the market rebounding, and now I think activity surged globally in the first quarter of this year to a year-to-date record. People are really trying to get ahead of changes in how people work, shop, trade, receive healthcare, all on the back of COVID-19. If I then kind of look at the public markets, I guess if you look at the Nasdaq 100, it's actually up 3% year to date. But I guess it's no surprise that it has been slightly volatile. If you would then look at many mid-cap tech stocks, those are actually down 30-40% from their highs. I think everybody saw the sell-off, the market sell-off that started in February because of increases in 10-year US interest rates. Inflation worries are still there, and that typically hurts stocks with high valuation, which are typically tech stocks. On SPACs, another hot topic that you mentioned. So, as you said, plentiful access to cheap debt, which resulted in a sharp increase in SPACs. If you look at this year, so the total SPAC IPOs year to date, so until the end of May, or until now May, has already eclipsed 2020. So in 2020 we saw about 250 IPOs, and year to date there's already 313. That said, US SPAC activity is now slowing down. Could be because of a recent change in accounting treatment on the warrant side, or the price that they're trading at, or increasing concerns around regulatory activism from the SEC. So if I just we track all the SPAC listings on a weekly basis, and we only saw 5 new SPAC listings hitting the US market over the past couple of weeks. So it's something that we're seeing more activity in Europe, but we'll need to monitor how that develops. If we then talk about M&A, and there's many different soft like sectors, and if I pick one, software, which is probably quite relevant. We saw a slight pullback in global deal value in Q1 of this year, but the number of deals actually continued to increase, from COVID times, so to say. In terms of geography, US is still leading, probably around 50-60% of the deals, Europe coming second, and then Asia. And then looking at valuation, and again, valuation is different for every sector. So if we look at, we have one index, which we call the SaaS index, Software as a Service Index. As of March, end of March, it's trading at 16.3 times trailing 12-month revenues, which is actually 53% greater than the 5-year average, and then 13 times next 12-month revenues, which is also 47% greater than 5-year average. So valuations are high. The market is very strong, and we continue to see that in our activity as well. I would say ever since last summer, it's probably never been busier for us and many of our colleagues in the sector.
Okay, so if a company needs your services, will you still be able to help them, or do you already decline opportunities? So
I mean, it's a good question. Obviously, we always try to help. We always try to help everybody, but we do need to look at and be honest with ourselves as well as where do we feel that we can add the most value. But by and large, we're trying to help everybody. The market as a whole, is growing. We, much like anybody else, is also recruiting heavily. So we'll manage.
Okay, good. Hey, maybe getting into the kind of pre-published questions on this panel, and first one is that is there a difference in the process for technology-driven exit versus a financial profile exit? And what if when you set the stage a bit on that, and then Priit, you would comment that what was Plumber and what was your experience there? But maybe Sven, first the question to you: that what's the difference between tech-driven exit and financial-driven?
No, it's a good question. I mean, we see a number of different companies, and of course, it's always hard to generalize. But if you would on the one extreme take a company with strong team, strong technology, perhaps fairly early stage on commercial commercial traction side, versus a company which is producing 10 million in ARR, EBITDA positive, perhaps a sizable technology business. I mean, in the way that we approach processes is that the one extreme, so the larger company, you can fairly easily create a structured process around it. You prepare the transaction, and that you go out to both financials, for example, private equity, as well as strategic buyers. That company will get sold, right, in this market. So it's really about good preparation, good structure, and then rolling out that process. I think on the other extreme, it's much more. It perhaps requires a bit more preparation, and we'll come back to that later as well. Where there is a saying that some of these businesses, they get acquired, they don't get sold. Well, that's not entirely true. There is a notion of truth in it, in the sense that it's important to make those links with potential buyers early on. If that is something that you have in mind, and a lot of VC-backed companies obviously have some kind of exit plan there. It's important to start early. We very often get calls from entrepreneurs that say, "Okay, our business is still early stage, but we have a term sheet. What can we do?" And then it really becomes a question on, okay, who have you been talking to? Who knows about the company other than the company that issued the term sheet? So there's definitely a difference. One being very structured, and you can drive it hard and fast, and the other one is more of an art than a science, and it needs a bit more careful consideration.
Okay. And Priit, which one were you at, like when the Splunk plumber?
Yeah, it's hard for me to generalize because I've only sold one company in my life. But I think we were definitely in the technology sale bucket. Plumber was still quite small. We had 7 people when we got sold. Our revenue was in the range of $1 million per year, and when Splunk acquired us, Splunk had more than 2 billion. So they didn't buy Plumber to get the bump
on the revenue.
in the revenue. But what they did buy was we were operating in the same market, and the Plumber product was in some ways it was a couple of years ahead of what Splunk had, and it was ahead, like in the same direction where Splunk wanted to go. And we had demonstrated that our approach works. We had customers that were paying. We didn't almost have any churn. We were growing. They saw that it works, and it, as I said, it matched very well their product vision. So most of the discussion or the acquisition process revolved around product vision, technology, IP, protecting IP, these kinds of topics.
So is it fair to say that they bought you to gain time?
Yes, I think that was one strong argument. Another one maybe was to grow faster, because they didn't have any presence in Estonia or in this region. We want to grow fast. We want to become a leading product in our market, which means that we need to hire. We need to find good talent. And Plumber had proven that we are able to find that talent in our region and hire it and grow working teams that can produce working software.
So speaking, like Sven was saying, that it's a bit of an art of getting acquired, like in this type of early stage. So how did you kind of get to this dialogue with Splunk that then allowed for things to proceed like this? That how did the engagement start?
Yeah, I agree with Sven that you need to grow these relationships. You need to know the people in your field. Interestingly, we didn't have a dialogue with Splunk before. That happened, as a coincidence. We were introduced by a person, like a common friend. I met with the head of product of Splunk, and initially we were like we weren't looking to sell the company. We were open to different ways of collaboration, but mostly just I wanted to speak to people in our market, and I know many product people in different companies, our competitors in the same market. I hadn't met Splunk yet because Splunk was quite a new player in our market. So I just welcome the opportunity to meet the product leadership, understand how they think about the market and the trends and so on. But then things just started happening. We saw that we were thinking really like in a similar way. Our vision was very, very close to theirs. But overall, I agree that if you already have the relationship, then it's much easier because a lot of what the acquirer buys is the team, is the people. And if they know the people, if there is trust, then it just makes a lot more sense. If you don't know these people, you take a huge risk. And if the people leave or I don't know, they are lazy or they don't match with your culture, then you'll just have wasted some money, but mostly you'll have wasted a lot of time and just made strategically wrong decision.
And I think that's actually a key part that you bring up there. A lot of these kind of, let's call them earlier stage acquisitions. It happens when the acquiring entity, really knows the team and the technology, right? And so if you would then, thinking back of a structured process, if you would put it in a structured process, the likelihood of somebody else engaging, without any, prior knowledge about the company, the technology, how good it is, the team, how solid the team is, it's very hard for them to engage on a short time frame. They will say, look, this looks interesting, but unfortunately, we haven't dug into the details, and it's going to take us a bit of time to get comfortable around technology, team, how this integrates into our product strategy roadmap, and that's why it's important to of course entrepreneurs need to build their business, but at the same time it's important to have those discussions and to make sure that people know about you and about the company and the technology.
So maybe a question to Priit, like here from the chat, and please, everybody who's listening and have questions, please keep them coming. And so question to Priit was that how hard or easy was the process of like talking to potential, I guess, like industry leaders that could then be buyers prior to Splunk came across, and any learnings from that, like what Sven was saying, that you build your own business, you have dialogue with others, so like how does that how do you kind of get to know like the potential acquirers without probably like broadcasting that I want to talk to you because you could one day buy me? So
I think my approach has always been through product, because we knew about this space already before we started Plumber, and we've learned a lot in the process. And I've always found it interesting to talk to the product people. So when I've built these relationships, I never approach corp dev or like M&A teams, M&A people. I usually talk to people in the product team, product development, or go-to-market teams, marketing, sales. I use the opportunities that life brings along. When I go to conferences, used to go when these things still happened, then I always visited the booths of competitors. I always asked to see the product. I want to understand how they see the market, who are their buyers, what are the value props of their product. I never conceal that I'm from a competitor. I was open with this, but they were always open to speak. And And sometimes these discussions led to other discussions. They introduced me to somebody inside their company, and so on. So it's mostly about what is the role of our products, of both of our products in the market, and how do we see the market going. And the good product people, they are always interested in talking about this.
And Priit, maybe a question from me, and let me know if you're not comfortable discussing this. But did you have any? Were there any other discussions, or was it kind of more bilateral discussion that then culminated into the acquisition? Or
you mean with other potential buyers?
Yeah.
We had been approached over the years by different companies who claimed they were interested. I don't know how interested they were. With some of them, we had maybe a quick intro call, but like we were not looking to sell the company, so it's hard for me to understand how much interest there was. A few months before we sold to Splunk, we actually had one company that was a lot more interested, and we even started slightly deeper discussions. But then their strategy changed, and they decided that they didn't want to invest in this field. So yeah, I guess if the more you speak, the more active you are in the market, and the more discussions you have. But it's really hard to say how serious they are before they actually end
Absolutely.
with the result. There are different motivators for different people to have these discussions as well. So sometimes they just want to learn something about the company and the product.
Yeah.
Good. We've covered like the first step of like getting to like let's say know the potential players in the field, and at least like that's one possible interest input. And then Sven, what would you say that what should a company do once they get like an indication of interest? Somebody calls Priit or another one and says that, hey, we are really interested, we are looking at your company, and we are looking at it with an intention to acquire. Then we'd like to probably get some more information that we can make a proposal. So what should an entrepreneur do at that time? So
yeah, I think then if you think of from a shareholder perspective, maximizing value, I think first and foremost it's about making sure that there is competing dialogues going on. It's the number one way. Competition is the best way to drive value, to increase valuations. So once those discussions become more strategic in nature, or even once a term sheet lands, I think it's absolutely crucial. Unless it's the deal that you've been waiting for at a valuation that you're super happy with, so you really don't want to jeopardize that deal. And those situations happen as well, right? Like we've been in deals where we are contacted and we say, look, we got an inbound offer. We want you on as an advisor, but whatever you do, don't lose this deal. This is the deal that we're going to accept, and this is the deal that we will want to do, which is slightly different from many of the other situations. So I think first step is engage, potentially engage an investment bank, but engage other buyers into the discussion. Provide them with an update. Say, hey, by the way, we've been having great discussions. Our situation has changed. To get other people active in the discussions. I think the second thing is don't rush into signing term sheets. Term sheets come in all sizes and flavors. More often than not, we see very kind of summary term sheets where a lot of the key items that you would want to have addressed, are not addressed at all, or they're written as customary. We will do this in a customary way, or reps and warranties customary to the market, and that's problematic in a way that because once you sign the term sheet, and more often than not, there will be an exclusivity clause attached to the term sheet. You're kind of yeah, I mean, you're never locked in, but you're kind of locked in because it will prevent you to talk to other parties. So it's really it's good to use that leverage. You will have the leverage until, most of the leverage until you sign the term sheet. So you really need to understand, purchase price, structure, how is working, or what's the mechanism to adjust for working capital. Also, when we talk about earlier stage companies, what's going to happen to the employees, right? Like, are all the employees offered an employment contract? Is it only the technical employees? If there is a selection, we always recommend it to be done after the deal closes, because it's something that that you shouldn't take care of. What about the contracts? There is situations where people buy or companies buy other companies for the technology, but they really don't want the contracts. So they will ask you to terminate all those contracts before the deal closes, which obviously is problematic for many reasons. The number one being that until the deal closes, you don't get the compensation, or you don't get paid until the deal closes. And if you need to terminate the commercial agreements before the deal closes, there is even though slight, there is always a risk that the deal doesn't close and you have just terminated all your contracts and as such your business. So these are all things that really need to be understood, upfront and documented from our perspective, documented in the term sheet or LOI. Also about, indemnification and liability, how are they looking at that? What is it capped at? Is something excluded? Typically, fundamental warranties are excluded, and it's kind of set very summarily in the term sheet. But what what people tend to forget is that fundamental warranties is really about the title to the securities that you sell, and giving warranties about the organization and the capitalization of the company. But very often buyers will try to move other things into the fundamental warranties, claiming, for example, that since we're buying this company for the technology, technology IP should be part of the fundamental warranties, which of course provides a great exposure to shareholders and founders, because if something goes wrong, you have to pay back all the money that you just received. Then also in terms of escrow, what's the size, what's the duration, and then governing law and style of the agreements. There's big differences between let's say Nordic law and US law and style. So in just a practical example. So in the US or in Europe and in the Nordics, you would disclose against the data room. So you can say, look, everything we put in the data room, we assume that that. In the US, that's not how it works, right? So you need to write the disclosure schedule, which can be weeks and weeks of management time, writing everything down that you already disclosed in the data room. So there is real life impacts on what you negotiate during the term sheet. And get a good lawyer, very important.
So for this term sheet, is it a lawyer or a banker who can advise on what are the most?
Yeah, it's both really. I mean, of course, we've seen, as bankers, we've seen our fair share of term sheets. I think the key thing is also to get a what I call a commercial lawyer. So somebody who can negotiate towards an outcome, rather than a lawyer who highlights risks. I mean, we see too many times lawyers focusing on highlighting risk, but it doesn't get deals done, right? You need to say, look, yes, we understand there's risks to anything, but here's something that that should be commercially acceptable, and we all move towards the same goal line.
So a lawyer should be used on every deal, but should a banker or advisor be used on every deal?
I mean, look, I'm of course not impartial to this. I think there's to me there's great value. One is to organize a process. It's one thing to have a bilateral discussion with a buyer. It's another thing to have 10 simultaneous discussions or more with different potential buyers, structuring that, making sure that the right things are said at the right time. It all plays into getting the right outcome, and then just organizing the company, knowing what will get asked, and making sure that you're ready for it.
Priit, what type of advisors did you use, like in your deal? That lawyers or bankers or both?
We use lawyers, and I definitely agree that there are different kinds of lawyers: the commercial negotiator type and the risk highlighter type. You need a lawyer who highlights risks, but who can also advise on, what is the probability of these risks, and what is custom in these deals, and how to ask for something in return, so that you can highlight the risk to the other party. You can explain how like impactful it can be, but you would know what to ask in return. Especially like in our case, we were negotiating with a huge company that was bigger than us, and it was easy for them to claim that it's part of our process. These terms are something that we've always used, and changing them is very, very difficult.
Yeah.
But if they're motivated, then you can negotiate. Like everything is on the table at the same time, and it's not like one thing against the other, but you have like 50 or 100 items that you can trade. We didn't use a commercial advisor or a banker. I think for one, like with this deal, we really the first phone call was not with the intention to sell. So we were not looking at the process in that way. And later, I don't know. On one hand, we already had these connections with other companies. We knew what was going on in the market. We also had a very good match with Splunk from the beginning. So somehow it happened that we did this on our own.
Mm-hmm. Mm-hmm. Maybe Sven, a question to you, that of the type of deals, like if you maybe have the statistics on this, that how many of the cases where you advise are of this type of nature, that there is this inbound acquisition interest to a company for like technology reasons, and the business doesn't necessarily like warrant a deal, but let's say that the technology value is there and the buyer is interested? And how many are then those type of like financially driven deals that the company's gotten where it can get, and then there's a decision that let's try to sell it or so? That is it possible to like share something in statistics here, that where are you used most?
Yeah, I don't have statistics on it. I think it's just looking back on the last number of years, I think it's quite in balance. I mean, there's always a number of processes that are ongoing, where it's kind of mature businesses that the shareholders have decided, or private equity owners, or any kind of other owners have decided that we should look at exiting our position. But at the same time, we're getting and maybe that has increased as the M&A appetite increases. We're getting more and more calls from entrepreneurs who have said, hey, we have what we think is inbound interest. How can we organize something around it? So I don't have statistics on it, but both of them are always on. If we look at our book of projects, maybe 60% is kind of more structured processes, and 40% is maybe on the M&A side is kind of maybe more earlier stage, looking to how can we organize something around this. But it changes.
Do you see bankers help like management and founders decide whether to sell? Like, I mean, that at some point, it's of course possible that the company startup has on its own come to the conclusion that we would probably like to become part of something else and we are ready to sell. But sometimes when this inbound interest comes, the idea was to still like keep continuing with your own business. So do you advise companies in assessing situations like this, that is now a time that we should consider selling, or are those things just privately decided? So
I think most of the time they are privately decided. I mean, either owners or founders, feel or think that, okay, we want to do something, and then we advise. I mean, we would never never tell an entrepreneur, here's what you have to do, right? Like, yeah.
Then coming back to this question that you mentioned, that the founders come to you and say that can you help us with the process? That do you have some way of assessing? Like, it's a question from the audience, that is the startup mature enough to proceed for an acquisition? That do you somehow qualify, or do you see something in the company that you could assess? They've got this inbound interest, but do you also assess that it's good enough?
Yeah, I mean, and it also applies to to different size of businesses. I mean, we will to the extent possible, of course, we will do our own diligence on the company. Of course, from a technology perspective, it's very hard for us to do that. So we would be looking at kind of external validation of a great technology, whether that's in a customer base, whether that's in a commercial traction, or whether that's through some of the discussions that they have been having, and then we'll make our judgment on a case by case basis, which is more about do we feel that we can be of value to this set of shareholders or entrepreneurs. If we feel that maybe we don't know the most likely buyers well enough here, or then we will also decline and say that, look, in this specific instance, I don't think we're the right advisor, and at least we pride ourselves on not just saying yes, because I think it's important.
Mm-hmm. Okay.
I think as a founder, keeping in mind that I only have one experience, but I think it's dangerous to decide that I'm going to sell the company before it's done, actually. Mm-hmm. Because if at some point, if you decide that, okay, now our company is mature enough that we are going to sell, then you stop developing your company, and your company will get less and less mature during the process. Yeah. So I also tried myself throughout the process. I tried to keep in mind or tell myself that nothing is done before it's done, and we keep developing the product, to keep doing everything as if nothing was going on.
No, I think that's a very good point, and of course, it's skewed towards the more early stage companies, where both the stage of the company as well as the shareholder base. I think it's like you're in the business of building a business, right? And that should be your first focus. At some point, before perhaps the company is financially mature, it does happen that other acquirers see the interest, and then it's up to the founders and the shareholders to decide whether that's something that they are willing to entertain or not. But like Priit said, it's first order of business is building the business.
So that's clearly like a good point on these things, that what can go like wrong in this M&A process later down the line is like, Priit, what you said is that you let your mind go too far, and then the deal doesn't happen, and you didn't build the business. And then Sven, you mentioned this like necessity to terminate contracts, and the deal doesn't happen. But what else have you seen that what can bite you later if you are not prepared?
Yeah, I mean the contract is one thing. Again, especially on the earlier, well, it applies across different stages of companies. But in situations where the acquirer does not value the contracts and actually wants to get rid of the contracts, it's important that the contracts actually allow it. I mean, we've seen quite a few, startups who, perhaps don't spend, the right amount of focus on the legal contracts. It's more like, okay, great, we'll sign this contract. It's a great client or it's a great reference, and we'll live with the legal text. But some of these contracts, they have uncapped liabilities, clauses that prevent the company, the startup, from actually terminating the contracts. And then it becomes problematic if the acquiring company tells you that, look, we need to terminate those contracts because you're just not able to do that. So it becomes a negotiation it becomes a negotiation in the negotiation. And then, of course, if there's contracts with uncapped liabilities, those liabilities, if not terminated through the contract, will move over to the acquirer. That's not something they typically like, and that's something that, if a problem arises, they will come back to the shareholders and claim that money back. So it's really important to sort it out. I think another one is financial forecast. Most of the smaller companies that we've worked with, one way, shape, or form, there's always kind of, issues around getting the numbers right, starting from, and especially on software as a service, like the recurring component. Overstating revenues, overstating deferred revenues. There isn't a proper reconciliation between the contracts and the billing records. So somebody's keeping track and creates a slide around, here's our MRR, and then when you really start digging into it, that doesn't really work out. And then you have to go back to the buyer and say, well, actually, we made a mistake. Now it looks like this. And this all goes to trust, right? So, we've seen it several times that this can become a big issue for acquirers, that if they don't trust the numbers that you send across, and if you have to update them, there's only so many times that you can get away with it. And then I think, another one is probably on GDPR. If you're dealing with consumer data, it will be a big item in due diligence. So make sure you're doing, what is needed on that front. Okay,
so unlimited liability is something to watch out for. It might be you feel all right as an entrepreneur, but then when it's a big acquirer, the unlimited limit is bigger for them than
yes,
for you.
Exactly. And also, it's likely that they would never sue a small company, but bigger companies would sue bigger companies because there's more to get.
Yeah, good point. That way you need to think about making your contracts like you were part of a bigger one when it happens.
Yeah.
Then there was a question from the audience, like on crisis impact on M&A process. That can there be some plan B that in case your process breaks down due to a pandemic or something like that? You must have had some of those experiences like last spring. And did you, Priit, also mention that you had something that started earlier? So what is there a way to prepare for this type of external crisis?
I mean, it's hard, right? Because if you could predict it, you're probably in the wrong line of business. You should be doing something else. Ultimately, at all times, you need to continue running your business as a going concern, right? If you embark on an M&A journey, it doesn't mean that you should forget about, for example, ongoing funding needs, right? It might be that, the M&A process takes, 3 months, 6 months, 9 months. Nobody knows. So if you devote all your attention and then find out that actually, the business needs a capital injection to actually continue running, that's probably not a good way to organize around. So first and foremost, it may happen, and that's how you should act. You should continue to run your business. If there's financing requirements, make sure that the financing is there. Could be bridge financing, because you don't want to give up too much equity. But make sure that the business can operate with or without the M&A.
Priit, any reflections on crisis impact to M&A process?
Yeah, I think it's very hard to protect yourself with legal measures, because if you start negotiating, in the first days that if we break up, we want to have some repercussions on you, it doesn't leave a good impression, and it doesn't work in your favor, because you start eroding trust already in the beginning. So I think the best thing that you can do to protect yourself against unknowns is to be honest, to understand the intentions of the buyer, and build the relationship and trust. Because if they really want to buy you, a crisis won't stop them. At least in my experience in a small company.
Okay, good.
We actually, to date, it's been 7 or 8 months since we sold the company. I haven't met anybody in Splunk yet. So maybe it's amazing, but it's possible to do these deals, even if there are very hard restrictions on travel.
Absolutely, I think that's actually a good point. I mean, when COVID hit, in March last year, we were in contact a lot with different funds, different buyers. I think the first reaction was that, pretty much everything slowed down. We then specifically asked that, how do you see this evolving? And I think, most people then said that, well, probably we can do some due diligence, remotely, but actually buying the company, it will require face-to-face, and it will require travel. I think that changed quite fast. And now, we've done several deals. Most of the deals that are being done now are completely remote. So where people haven't met physically.
We have the same experience. I mean, over the past 6 months or so, we had or so, maybe it's 7 months, but we had 3 acquisitions from Karma portfolio, and all were remote. And and then that's really the way things are done. Wanted to ask a question about again from the audience here about bigger acquisitions. So when companies grow to be big in valuation on billion dollar level or billion euro level, is there, Sven, a big difference on the M&A of that size of private companies in terms of geography? Do European buyers know how to buy big companies worth more than $1 billion, or are they kind of more confined to smaller acquisitions?
I mean, there are more unicorns in the US and Asia, right? That's just where it is today. Having said that, the number of unicorns is growing everywhere. I don't think there's historically. I mean, if you look at, and maybe that's one side of that coin, even though it's less and less of an issue. I mean, if you look at the very big rounds of capital, a lot of that capital is if we do a big capital raise, the amount of funds in Europe that can support that, so to say, is smaller than it is in the US and Asia. I mean, that's just a fact. It's changing. There's more funds putting more money. But that's just, that's how it is.
And is there something fundamentally different in the public markets that makes US better at buying bigger?
Not sure I understand the question, but no, I think, look, I mean, there's a number of amazing examples in Europe of unicorns, and I mean, there's no impediment to them being acquired if they so wish as private companies.
So basically, like no, like there's companies that get acquired early, and there's no problem in getting like acquired later or then going public. So sounds good. So any closing comments, Priit or Sven, you'd wish to make? I mean, it's been great to have you here on this dialogue. Really appreciate the time and your openness and thinking here.
I mean, I think, maybe just, for people or founders that are thinking through this or are now in a situation where, they're starting to think about this. I think, the number one thing is make sure to get your house in order, so to say. So understand what is driving value. Bankers can help with this. Understand how you perform against some of your competitors, fix some of the weaknesses that you have, whether it's, customer concentration, whether it's on the contract side, whether it's GDPR, and then, make sure that, by the time that you need competition, if you're an earlier stage company, that there's enough companies that also know about you.
I agree. We benefited a lot from having our legal docs in order. We didn't have a very complicated system, but we had stored all customer contracts and vendor contracts, and they were all gathered in one place, and it was easy to just assemble them and use them in due diligence. But I think I would, from the startup founders' perspective, I would add to what Sven said, that you should also know the market well, both because you want to build a good product, but also know what the big players are doing, because markets are always changing, and you will see big players entering your market and starting doing something, or big players in your market expanding their portfolio, looking elsewhere. And if you can understand these trends, then this will open new perspectives for you as well.
All right. Thank you for those closing words, and thank you again, Sven and Priit. Great to have had you here, and looking forward to seeing more people join the other Karma Academy tracks. So,
all right,
speak soon. All right,
thanks all.
Have a good day, everyone.
Bye now.
Bye.